Hi everyone, this is Tom Whitlock. I'm a business development consultant at Clifton Asset Management. We're the team behind pension-led funding, and I'm very pleased today to be joined by one of our senior financial advisors, Anthony Malcolm, to discuss borrowing money from pensions. Anthony, first of all, how are you? You good?
Hi Tom, good afternoon. Yeah, very well, thank you. Hope you guys are well too.
Good to have you on board. So topic today is about borrowing money from pensions. I suppose we've got to start with the basic question at hand, which is who can borrow money from a pension? Is this something anyone can do, or is it only certain types of people?
Essentially, Tom, you have to be a business owner to access this facility because a corporate structure is needed as the counterparty for the borrowing. So essentially, business owners, directors, with limited companies are eligible for this kind of funding.
Sure. And if you're a business owner and you've got a pension fund, could they borrow straight from that fund already, or would they have to do something to it first?
The short answer, Tom, is no, because there is a specific framework that's needed to support what we call self-investment lending with a pension. And that framework is something called a SAS, or a small self-administered scheme. A bit of a mouthful, but a SAS is a specialised form of corporate or occupational pension scheme, which is established with a limited company as its sponsor. And it's that framework, which is HMRC approved, that can support the kind of lending that you're talking about.
Sure. And for a business owner that may have some pension funds they may have paid into in former employment or private schemes, what are some of the steps involved, and I suppose where would you come into the process?
Well, essentially, Tom, any kind of pension transfer or consolidation exercise, as you might imagine, is heavily regulated. And where the regulated advisor comes in is looking not just at what can be done, but also what should be done within a single framework. And that single framework in this instance would be the SAS. So you end up with a consolidated pension position, and that starting position then determines the lending scope.
Sure. And that lending scope, are there any restrictions to what the lending is for, rather, or are there any features that you should know about the loan before looking further into something like this?
Yeah, for sure. And as with all HMRC regulations, they are relatively complicated and need to be carefully navigated. In essence, cutting to the chase, so to speak, a SAS can use 50%, up to 50% of its value to lend to its sponsoring employer. That 50% doesn't have to be a single loan. It can be any number of transactions of that debt to be formally secured in the same way as a third-party lender would ask for collateral, and that's to protect the pension scheme. And the pension scheme also has to receive a commercial rate of interest to compensate it for the risk of lending, and also the opportunity cost of not having those funds available to invest in the markets, for instance. So there are these key tests that HMRC insist are satisfied, and we work jointly with our trustee company to ensure that those parameters are met.
Okay, and are there any other key features of the SAS that might be relevant beyond its ability to loan money to a company?
Yeah, certainly. One of the key, I think, features that SAS can offer is the ability to invest in commercial property with or without mortgage funding. And that's actually quite powerful for business owners, because you can think of a situation where your company resides in a commercial property, a commercial unit that your pension scheme owns, and your company pays rent to your pension scheme rather than the third-party landlord. And you do see a lot of SASs with commercial bricks and mortar on the balance sheet, and that's quite a compelling offering for a business owner who would prefer to pay rent to his pension than a third-party landlord. I think the other thing to bear in mind is that under HMRC rules, a SAS can have up to and including 11 members. Now, it's unusual to see a SAS with more than, say, 4 or 5 members, but it's important to understand that this can be what's called a common trust fund. And the significance of that, again, for business owners, is it allows like-minded individuals, perhaps fellow board members, to effectively syndicate, to collude, to bring their pension benefits together, whereby they may be able to achieve more than they could as individuals, particularly in terms of lending to their business or indeed buying a property. So it's a very sophisticated tool. It has a significant provenance, and it can be used to the advantage of business owners throughout the country.
Certainly. Well, Anthony, thank you very much for sharing your thoughts and imparting that knowledge on us. I think we've covered quite a lot there in a very short amount of time, so very much appreciated on that. If there is anyone at home that might be looking at this and thinking they might want to have a look at this for themselves, or indeed they might have a client that they might think this is relevant for, please do feel free to get in touch. I'll arrange for some contact details to come up at the end of the video, or you can head over to www.pensionledfunding.com, where there's any number of frequently asked questions, case study examples, and as well as all the ways to get in touch with us to discuss this further on a no cost and no obligation basis. But for now, Anthony, thank you for your time.
Thanks, Tom.
Thank you to those at home. And yeah, tune in for the next episode of Ask Tom, where we'll be covering off more about what your pension can do. So take care. Goodbye.